Today, we're going to talk a little bit about the UK employment data that has come out and whether it's going to cause the Bank of England to change their mind a little bit on where they go with monetary policy. And then we're going to move on to gold and take a look at a nice little channel that's formed and then see, what might influence the price of it. And then for the trading takeout today, it's going to be make the subjective as objective as you can. I can't wait to get into that a little bit. So the UK's ONS released the most recent jobs and wage data, and it's kind of a mixed bag. It's not so bad, especially when you gauge it against the historical average, but it's not great either in the context of things. So we can see here the average UK weekly earnings on a quarter-on-quarter basis, year-on-year basis, was 8.5% versus expected 8.2%. Its annual growth rate is affected by the NHS and civil service one-off payments made in June and July 2023. So it's basically saying that the wage growth data was boosted by large payments made to the public sector employees. Now, the payrolls change was zero, so there was no change in payrolls, but the employment change, which you can see here, was minus 207k versus expected 185k. So a little bit worse than expected in terms of employment. Now, unemployment ticked up a tiny bit by 0.1% from 4.2% to 4.3%. But you can see some pretty good analysis here from the guys at News Squawk, where it says UK vacancies and jobs in May to July, the number of people employed per vacancy, the number of people unemployed per vacancy was at 1.4, up from 1.2 in February. So it shows a slight loosening of the labour market as the number of vacancies fell against an increase in unemployment. Now, straight away, what that should signal to you is that the Bank of England probably wants to be a little softer on inflation, because a tight labour market should indicate spiralling wage growth. There's too many people looking for not enough jobs. So people can demand a higher salary for what they want to do. Now, if we're looking at what they might do at the next meeting, it's basically nailed on for 25 basis points. So they want to increase by 25 basis points. Now, this could change because we do have a few doves in the Monetary Policy Committee. We've got Tim Rayro, and we've got a couple of others, but she's the main one. Now, my view is that they probably should go 25 basis points, purely because I think it enables the market, since the market's nailed it on so well, it enables the market to not be shocked, basically, at such a crucial time. I think I spoke just yesterday or the day before that one of the most important things in markets for stability is just simply not to be shocked. It doesn't matter if the data is bad, but if the expected data is bad and it comes in bad, in line with expectations, fine. But when the data is expected to be okay, but it comes in really, really bad, then obviously the market's going to move massively. I want to shift over to how sterling behaved off of this, because it's very muted. It's an interesting one. The market's not taking it as being that affected on a rates basis. FX moves in line with rates, and what we've seen is just this range taken. So we saw the high taken first, fell, took the low, and then you can include this low in there as well. So these news events, can create just some volatility to take a range, high, low, or low, high. And if you do tend to see that, if you do tend to see a fade coming off of the initial run, you can make a probabilistic bet that it's going to happen the other way as well. So let's say, for example, you can identify this range. You've seen that the volatility is relatively flat. It could be good to, if you see this initial move, to post some bids here. Okay, there's people that are buying here. People probably got their stop in a rubbish place. Recent buyers here, stops under here. The volatility on a mixed bag event where the market doesn't really take it as good or bad, it's just meh. It enables these kind of range plays. And then, you just trade it back to the middle. You don't do anything that drastic. There's only 10 ticks in there. But it can work if you do that a few times through the year. That's an extra bit added to the P&L. And naturally, you'd filter down and you'd look at what might influence it better, what conditions might increase the strike rate, increase the risk to reward, etc., etc. But these are events that are tradable among the right context. So 100% take that into account. But in terms of where sterling's likely headed, I don't think it's going to go anywhere based off of this data. I do think that if we start to get some statements out of the Bank of England suggesting we still need to be strong on inflation, etc., then we could probably look for some upside. I did notice this little target here. I do like double tops and double bottoms as targets. I think they're great because you can identify perhaps who would want to be selling here. People that have already sold here, they're stuck in their way of saying, okay, I need to sell the pound. I've made this money. God, I've made it to here, but now we're trading back here. I want to try the same trade again. But instead, lots of people jump in there because this looks like a great area of resistance, and instead they just get wiped out. Okay? And they keep selling probably through here. They might even try sell again up here, in which case you see if you can repeat it. And if it doesn't, you might look and see if you can buy it back again here. But that's all probabilistic bets. You see how the market behaves at each stage. You see what the selling or buying looks like here, and then you retrade it accordingly whenever you return to a prior area of business. And that is really the key with trading. You're looking at areas where business has been done before, and you don't necessarily have to initially have a view on where the direction's going. You should have an economic view, and you should have a view of what participants are thinking, but not at every single stage. And you look at what occurs at areas of key business. So you're not going to trade anywhere here, for example, I don't think. You wouldn't trade here, but you might trade there because there was activity here. There was a fight going on. And this is what we see here. Excuse my very poor drawing there, but you see that the market returned up to this area of prior fighting. And now you can paint a picture perhaps as to what might happen in the future. And then you just examine it and see if similar behavior occurred. See if the similar interest was there, see if there was similar sort of price action. And also to reinforce that, you see if there was, if there's the right kind of news, the right kind of news flow, data coming out to support your view, whichever way you go. So that's the way that you should paint a picture going forward. Okay. And I think we should move on to gold now. Right, so I've got something really quite interesting to show you here, and it leads on to the Trading Takeout as well. And what I'm looking at here with this channel is I've not just got some lines and just drawn them, and there's a reason for that. So in TradingView, which I want to presume that most people have because it's a fantastic tool. I did used to work for them as well, so I'm slightly biased. But it's called this regression trend. And what that basically does is it finds the average and it runs a linear regression along the whole data set. And the way that I like to use it is by doing the following. I will delete this and I'll add it back on again because it will show the logic here. Where are we gone? There we go. So I like to take it from a prior key high, this on the 4-hour chart, to the most recent low. You don't want to include more recent data because effectively that would kind of disrupt what you're trying to look at, which is a trend. If you include recent data, then you're basically curve fitting the linear regression. Now, what do you notice? So I've set this to 2 standard deviations to the upside and 2 standard deviations to the downside. You could probably add another channel here for 3 standard deviations, but it's set to 2. I think that most data, if you're looking for what we're looking at, which is a range-bound trend play, it's going to fit 2 standard deviations better. If it does tick up to 3 standard deviations, then you might change your outlook and you might actually look for a breakout. But in this context, what we're looking for is this linear channel, this linear regression channel has formed lovely tops and bottoms. And this one actually obviously wasn't a data point that was included, but it shows how important it is. So even though it wasn't included, it's still following the same regression. Now, the way that you might look at this is by saying, okay, so we've got this channel here. This is all based on data. Let's ignore the macro backing for a second, but we'll bring that in afterwards. We're hitting up to the upside and we're trading back down to the middle. The middle is always going to be the actual regression, obviously. So this is the line of best fit, if you like. That's probably the best way to word it. And then this is the standard deviation of that R squared line of best fit. And so what you can maybe suggest here is every time we touch a standard deviation, price should return back to the R squared. Otherwise, the linear regression breaks, right? So there's a trading strategy perhaps in there, along with some other factors. You might look at saying, okay, well, we've traded now back here. We're trading back up to our limit. So consider maybe the standard deviation as the limit, as the support or resistance. Let's see if we can have a trade back to the middle. Oh, it's fallen through. How likely is it that it is going to go now to the two standard deviations to the downside? Oh, let's see what it does here. Oh, it starts moving. Okay, we got another one. Now, at each stage, though, you can then bring in the macro back in and say, what's happening in reality? Are real rates higher? So real rates here since June have actually been higher. Are real rates now higher again to tick this back down here, which is the key driver of gold? They have a negative correlation. Are real rates decreasing again to drive gold higher here? Do you see what I mean? So there's different ways to look at things. You can have your technical basis, and then you can have the macro backing that really, really solidifies your technical view. Alongside this, going back to what I was referring to about areas that people do business in, that should absolutely be factored in as well. So this would be an area of people doing business. You can see that they've done business multiple times before. And I like to say done business because it reinforces that trading is a business, or should be treated like a business. It shouldn't be treated as a punt or a gamble. Obviously, emotion comes into it. Emotion comes into business. But you've got to think of everything. You've got to think of the cost of your positions. You've got to think of, okay, I'm paying out this much to make how much, inclusive of commissions. What is your cost of inventory at the end of the day? And your positions are your inventory. That's how you make the money. But that's just a little primer on gold. And let's move on to the trading takeout. Now onto something that I think is really important, especially from my own perspective as quite a discretionary trader. And that thing is to try and remove as much subjectivity as possible when you're actually trading the market. Now, it's fine to have a view, but I think when it comes to execution, the market doesn't actually care whatsoever about your opinion on what's going on. Neither does risk management. Risk management is probably the paramount thing that I'm referring to here. So for things like stop loss placement, most people like to throw a stop loss, above a high or below a low. Now, the problem with this is that when you actually speak to these people, and you ask them, how do you get stopped out? Like, where's the most likely place? It's like, I get stopped out because they, did a stop run and stopped me out above this high, and, they're cheating and stuff like that. It's just not true. Your stop was in a rubbish place. What I like to do instead is to look at things that are based more on a volatility basis, whether that is average true range or, working out the daily or weekly or monthly expected move from implied volatilities. These are all easily Googleable, by the way. I've got an Excel spreadsheet because I can't actually remember the formula, so I just input that there. Or another measure, but trying to introduce a method of systematic objectivity into your trading to remove where you might, as a human, be completely biased or completely wrong on something, or, just have a blind spot. It makes things so much easier because then you don't have to worry about the thing that tends to be quite emotional, such as stop loss placement. You can just say, oh, the market's caused this to change now, rather than thinking, damn, I put my stop in the wrong place. Because if you do this thing over and over again, such as use average true range or, daily, monthly, weekly expected moves, you can just say, well, that's what happens. It's systematic. Let's go on to the next one. You don't feel it personally because you didn't make the decision. So that's what objectivity brings. It removes accountability on yourself almost and puts it onto the data.